So you were telling me about your Whoop scores.
Yeah. So for those of you that don't know, Wheeler and I are active users of Whoops, and you used to have an Apple Watch that you were really
I still
into.
have the Apple Watch. I just use it for workouts.
Okay. But then you have your 8 sleep too.
I
which
also have
tracks
an
your
8
sleep.
Yes.
So a lot of tracking mechanisms. Oura Ring?
No Oura Ring.
Okay.
Yet.
All right. Well,
Yeah.
now I know what to get you for Christmas. So with that being said, last night before bed, we were watching Stranger Things.
Yep.
And I got caught in my own dreams in a Stranger Things scene that made me sleep very poorly. It was season 2.
I was about to ask.
Season 2, where there's the tunnels underneath the town, and it's like the, what's it called? Not the down under,
the upside down.
Upside down. Yeah. So it's the upside down with the tunnels underneath. It's a scary scene.
Scary stuff.
And I was trapped in the tunnels underneath my house.
This is why Jess doesn't watch the show.
I don't know. Kaylee always insists on watching it right before bed.
Yeah.
And it's definitely not a great bedtime watch. So I got stuck in this situation in my dreams. And I woke up last night multiple times. And I didn't think I slept particularly well, but I was just telling you, I was up at 2, I was up at 3, and then I was up again at 4. And I was surprised because when I woke up this morning and looked at my Whoop scores, I have a 94% sleep performance score.
Yeah.
And I don't know why my sleep performance score was so high, despite the fact that I was up so much.
So I always found navigating the Whoop to be a little bit misleading. And I have to correct you because I'm a retired Whoop user.
You said you were taking you were saying you were going to take a break, but are you done now?
Well, I did pay for an annual subscription, so I don't know if I'm, done.
You may re-engage.
I'm taking the break because I wanted to kind of like reassess things. What I learned about the Whoop is that so much of it is like trend driven that I was, paying attention to last night's score, but last night's score wasn't really just about last night. It was about last night in relation to the last 30 days, like weighted more heavily on the last 7 days.
Mm-hmm.
And it was all about like just trends. And what I realized is the healthier you were, the harder it was to measure against. Right. So like if you had a really great, like if you really ratcheted everything up and get it all tight, and then like you did one thing slightly different, you would get like quote unquote, the way I felt was punished by my Whoop.
It's like if you hadn't had a beer in a week,
right.
Then you have one beer, then your recovery score goes from like a 90 to a 60.
Right. Yeah. It's your HRB in relation to like whatever. So I went through this a few weeks ago and I'm on a break with my Whoop. Because I realized I said this to Tori, I said I was gamifying my health. And Tori was like, yeah, I already told you were doing that. But no, it's a unique new idea that I do this with Jess all the time. I'll say, I think I should do this thing. And she'll be like, I told you to do that thing.
Months ago.
What are you talking about? This is not your idea.
I had this great idea.
I have ownership over this idea. So I realized that I would wake up in the morning and I would look at my Whoop app and try to I get graded essentially on how I did the day before, not just the night before. It's like the whole day, right? It's like all the choices that you made all stack up to one thing. And then you wake up the next day and look back on those choices. And it was essentially like looking for a pat on the head. Like, I'm a good boy. And here's your green score, or maybe your high yellow score. Oh my God, a red score. Oh no.
Don't do anything today.
You're going to make some changes.
Yeah, go back to bed.
And I was assigning too much value to that, too much of like my own like progress. So I had this. And then over the weekend, I listened to a podcast episode about the same thing. And it was Derek Thompson talking about how he realized that his Whoop might not be measuring the things that are most important to him.
What?
Well, the Whoop makes HRV kind of like the most important thing.
Yeah.
But it could also be that catching up with a friend the night before over cocktails was more important
than his HRV.
Than the HRV. And I felt validated because he, being just like a very talented writer and a very talented podcast host, more talented than this rookie over here.
We don't know that.
I think he more eloquently, described what I was feeling. I'm this is in alignment with a lot of the pushback I'm having this year against like goals and the measurements or whatever, because you and I like to measure so much, and we're so, I don't want to say obsessed with it, but focused on it.
Mm-hmm.
And now I can look at your journey there and be like, man, I'm so glad I'm not doing that.
Well, I have to say that I know you've taken a break from Whoop, and I have kept wearing mine. But last week there was what I will say is, when I first started Whoop, the first month I was like stressed out about my sleep because I noticed my sleep scores were bad. Like my workout routines apparently weren't in line with the amount of effort I should be putting in. And it put kind of all this pressure. And then I'd have anxiety about going to bed, about whether or not I'm going to hit my score and stuff like that. Then I got on a good track with it. And for 6 months, it was really great. And I think I've had it for around maybe a year now. And I didn't wear it for last week. I hardly wore it at all.
Yeah.
And it's not that I actively chose to not wear it. I just didn't think to put it on, because I take it off before the shower, and then I just go about my day. But I started wearing it a few days ago. I was like, oh, I'll charge it, put it back on. And then this happened. So now I'm like, well, if I don't really care that much anymore, then why am I going to pay for it? Like, if you already have the habits, like, generally, like at this point, what to work on, then once you've gotten majority of what you can out of it, just, is it really adding that much more value?
Well, that's kind of my point. Yeah. Like I had an Apple Watch on one wrist and a Whoop on the other, and my 8 sleep at night, and I was tracking everything. And I learned a lot about my habits and about like how different choices impact me. And I think I did the same thing. Have you ever done calorie counting?
Yes.
Okay. When I did calorie counting, I would stick with it for maybe a month if I'm like being gracious with myself or generous. And I realized like I can learn from like some of the healthy dietary choices, and you can kind of just take those with you and not have to go through the labor of actually tracking it.
Yeah.
Which is the worst part.
Well, it's also like the ideal calendar that everybody tells you to do. I think it's the name of that book about the like the successful CEO or something like that.
Sure.
I can't remember the name of the book, but it's a very
Perfect
famous
CEO
book.
or whatever.
Yeah, something like that. And it talks about tracking your time, and it's a good exercise to do, but you don't want to always be tracking your minutes.
Totally.
Yeah.
I think it's worth putting time into tracking things that have an impact on your life, and then learning how to keeping that knowledge with you and carrying it throughout your day. And then just making some choices based on that without having to always actively track it. And another area where you can do that, Colin? It's budgeting.
Yes, that is true.
Which is what we're talking about today. Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth. From financial growth to career growth, personal development to societal progress, we explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it.
I don't want to say we're just talking about budgeting, because I feel like everyone's going to tune out.
I hate the word budget.
If we say budgeting.
Yes, I agree. I tell people, I don't say budgeting to clients.
Yeah.
I say spending, which I think is a little bit more freeing. And I think that's kind of like we talked about this a lot before. And we talk about Matthew McConaughey so much in this podcast. I feel like we should invite him on as a guest. But one of the things that he's said that's always stuck with me is that he likes to establish some boundaries, like processes, boundaries, so he can live life freely within the construct of the decisions that he's already made.
Yeah.
That's very freeing. And I think about the way we look at financial planning, tracking your spending, knowing what you spend, knowing when you're spending a little bit more than normal, et cetera, allows you to spend more freely if you've already kind of put some rules and optimizations in place.
Yeah. I think I 100% agree with you. In regards to spending, it's not just spending too. There are other foundations we have to talk about. And I guess the mental image I have in my mind is, if you have a table that a Jenga set is going to be on, you need the table.
Yeah.
So you're building the table, and then the pieces go on top.
I actually, even better analogy, it's the foundation that you're building your dream house on.
perfect.
right? Because you're going through this right now.
I am.
You had to go through the digging out the hole, laying the foundation, doing all, what's that metal pipe that goes? Rebar.
Yeah.
Trying not to
get impaled by it.
Impale anybody with the rebar. And now that's all laid. And now you get to do the fun things like picking out the door handles. And
exactly. Yeah. Sourcing things from China.
Where and where your window should face over your sink, or those are aesthetic designs that you get to like live with and appreciate. But you get to do that because you don't have to worry about the house falling down.
Yeah. So in my mind, there are some pillars that we need to talk about today, spending being a main one. What are some of the other pillars?
So the way that I think most financial planners look at it, and we certainly do, knowing what you're spending allows you to know what you need to have for emergency reserves.
Yep.
Right. Which then allows you to understand what you might need to have for insuring against a bigger issue. So you have this lifestyle, and it can be a very healthy lifestyle. We're not looking at, restrictions or coming from a scarcity mindset. We're saying if you have a high performing lifestyle, or if you don't, either way, knowing what that lifestyle looks like allows you how to ensure that you get to continue that lifestyle, and then insure against something more catastrophic, which would really derail that lifestyle.
Right. Yeah. You need to start with the spending. And we always say this when it comes to financial planning. It's like, you can't really build a financial plan if you don't really know how much you actually need to spend.
So important.
Because the whole purpose of having money, well, in retirement or in any aspect of life, is to either protect or continue a lifestyle.
Yeah.
And that is where the insurance aspect comes into it as well. And that is also where other topics that, we can branch off into. But I guess in regards to spending, people think budget and they think restrain. I need to hold back on my spending.
Yeah.
It's not what we're saying today. What we're saying is that if you're spending 10, 20, 30, $100,000 a month, it doesn't matter to us, but we need to identify what that number is so that way we can plan. Is that fair?
Yeah, that's absolutely fair. And I think within that number, there are levers that you can pull on. There is the necessary and the excess, right? And, the things, or it's really important that you should know the things that you need to have that, let's just look at this kind of like a family standpoint, right? If you're, a young single person, you don't have as many pressures on you to like continue spending at a certain level. Once there are complexities when when you have a partner, when you have a family, there's more and more people depending on some sort of consistency, right?
Yeah.
So I think that, having a roof over your head, right? Having nourishment, those are like probably the two most important things, followed by maybe, clothes on your back, or, cell phones. Like
I was going to say tech.
Right. Yeah. Like it's streaming and self-service and whatever.
Can't live without it.
Yeah. The things that are really important to modern life. Right.
Yeah.
And then you can, from there, you can think about, well, I really appreciate community, and like, where do I find my community? Maybe it's I go to church, maybe I go to drinks with friends, or maybe I go to whatever. Right. And then that's like, it's important. And we're not saying it's not important, but is it as important as you're paying your rent or your mortgage or whatever that might be?
Fair enough. Yeah. One exercise that I often tell my clients to do once a year, whenever the frequency is oftentimes people will look at their credit cards and they'll break it out into different spending categories for food and all that kind of stuff and travel. I actually don't think that that's a wise necessarily thing to do because your travel will vary depending on where you go. Emergencies come up that you might not anticipate. Home maintenance is different one year versus another.
Yeah.
So it's really difficult to break it out by categories and say, okay, this year I'm spending $10,000 on travel, and this year I'm spending $5,000 on my house, or this year, whatever the category might be, because we know it's going to change. Life comes up. I think a better way to do it would be if you were to just download your bank statements for the last 6 months or even a year, total up all the spending that went out and just took the average of it.
Yeah.
That to me, and then like if you really wanted to be safe, then I'd multiply it by like 1.1, give you some buffer there too.
Yeah.
For me, I don't care so much as a planner about the categories or where people are spending their money, but I want to know how much you are spending.
No, it's a really good point, because there are a lot of things you spend on a monthly basis, right? Like the mortgage, for example, whereas home improvement projects or travel will be like
Christmas.
Yeah, Christmas. sometimes people say, well, it was a really expensive season. It was Christmas, so we spent X number of dollars. Or we went on this trip to Ireland and we spent X number of dollars.
Or I bought a new car.
Or whatever. And, but that's not normal. But then if it keeps happening,
it actually is normal.
It's pretty normal.
Christmas actually happens once a year.
It's pretty reliable, actually.
It is.
And once you get accustomed to a certain level of spending, it's hard to go back. We've talked about that with like the lifestyle creep.
Yeah.
So I think it's just really important to just call it a spade, right? Like just know what you're spending. It's not about judgment. It's not about shame. It's just like, hey, here's what you are planning on spending.
Mm-hmm.
This is what you enjoy about your lifestyle. Let's make sure you can continue to do that.
For sure. Yeah. I mean, it's just all about protecting that basis. And we're not here to say like, if you're really into cars and you want to spend a lot of money on cars, go spend a lot of money on cars. If you really want to travel a bunch, go travel a bunch. I'm not here to say spending in one category is right or wrong. We have a ton of clients who are big foodies and they travel all over the place to try different restaurants.
Mm-hmm.
That's great. That doesn't bother me. The only thing that I think is tough at times is people will come in and they will say, I need $10,000 a month, in my retirement. But do you actually need $10,000 a month? Have you averaged the statements? Have you actually done this exercise? Because that to me, the spending category is equally, if not more important than the actual amount of assets.
Yeah.
We talk about this a lot, but if you're not meeting your retirement goals, you can do one of two things. You can either spend less or make more. But if you spend less, that can only go so far.
Yeah.
You can't cut out your mortgage. You can't cut out food. You can't cut out cell phones.
Yeah.
But you can work to make more or get more insurance or whatever it is to try to get to that point. In most cases.
Yeah, totally. Yeah. And I think that it's, if you look at it as, again, just reframing it, changing your point of view and saying, I can only spend this amount of money. It's I spend this money or I get to spend or whatever it might be. Yeah. And then you use that to inform all the other decisions. And people love to jump into like, I want to, 10x my stock portfolio. So I'm going to like go all in on
NVIDIA.
Yeah, NVIDIA is the first thing I was going to say. But it could be Robinhood. It could be,
whatever stock.
Kalshi trades on nuclear strikes. I don't, whatever. But I think the things that are really exciting, I get that they are exciting, but you have to lay the foundation first because those exciting things, if they blow up, if you have, $2,000 and you're 25 years old and you've got a reliable income or whatever, and you're single, you can throw that all on whatever you want. And if it blows up, it's not going to destroy you. But if you've got a family of 4 that's living off a single income and you're, just YOLO on whatever the stock portfolio it is, and you don't have that money when you need it because your single income goes away, that's when there's a crack in the foundation and your house can fall in.
I was watching a YouTube video, plot twist, over the weekend, and it was on this real estate or house tour, something like that. And you know how they do those ads where it's like and the people who are doing the YouTube thing is like, hey, Squarespace or whatever is, offering X
now
amount
our
of
sponsor.
Use, exactly. Yeah. The sponsor to this real estate tour of this house was a uranium penny stock. And they were trying to steer their viewers into investing into the penny stock. I don't know how that's legal.
It shouldn't be, but
that blew my mind. A bit of a tangent, but I guess when you said go YOLO on one stock with your stock portfolio, I was like, that is actually out there quite often.
All the time.
And then I sometimes get pushed Reddit forums too on people really, really, there was what was the movie with Seth Rogen?
Dumb Money.
Dumb Money.
Yeah.
When they were talking about GameStop.
Yeah.
That stuff is out there, and I know everybody wants to get rich quick.
Totally.
And you do see that happen quite often. And when I saw that ad, it just brought me back to Dumb Money.
But I think that, you have to just understand what the real risks are, right?
Of course.
And the risk is not missing out on a GameStop, right? The risk is just not being able to pay your bills. I think let's just talk about what the recommendations are on average. What's the, by the book, black and white recommendation for an emergency reserve?
3 to 6 months. And in the same way, with retirement accounts, they say, 25 times earnings or something like that. Take what you spend and multiply it by 25. And that's what your retirement portfolio should be. Those are and then you have the 4% rule.
Yeah,
those
rules.
are the 3 main rules.
See, I think about that, and it's, there are nuances to it, right? Like if you lose your job, for example, you're not paying as much in taxes and you're not saving into your 401k. So you don't need to replace your gross income. You just need to replace like the necessities, the lifestyle stuff. So it's, if you make $150,000 a year, you don't need to have, 50,000. No, that's not right. That's bad math. Whatever. 30,000, whatever.
Yeah. It would be 36,000.
36. See, there you go. You're the numbers guy. You don't need to have that gross amount backed up with like 36 to 75,000, whatever, somewhere in there. You don't need to have that.
Yeah, because that would be 3 months of gross earnings, essentially.
Yeah.
Would be that amount.
I think it's just people, look, there are a lot of decisions that you get to make, right? If you're a young high earner, you might have like stock options available to you. Yep. You might have the opportunity to participate in your company's performance. You get to put money into a 401k, right? You could put money in an HSA. You could put money in a 529. There's so many different places to put money that are more restrictive when you need it, right?
Right. I think one thing that sticks out for me that you just mentioned that just came back into my mind was I think people think they need a lot more than they actually need. And to your point, the 401k and taxes and all of those things, like let's say, for example, someone makes $200,000 a year and they're putting 15% into their 401k.
Yeah.
And they're, coming up to retirement. And then they also have taxes on top of that. What they don't realize is out of that $200,000, if they're putting 15% in, well, that's $30,000 going towards their 401k right there. So now they're down to $170,000 of income. Depending on your state and federal bracket, if you're married and joint earners, you're probably, when you add it all up, 25 to 30% there as well. So right there is another 41,000, 51,000 that's going to be shaved off. So after all of that, your take home pay is 100 and call that, what is that? Like $124,000 is what's going to come out of that. Basically $10K a month. But people are like, no, I make $200,000. It's
right.
Like, well, no, that's not true. You have like a good chunk of that going to your 401k, 30,000. Then you have another roughly 50K of taxes between both federal, state, Social Security, and Medicare. So you might not actually need as much as you think.
Yeah. I think what the amount that you need in an emergency reserve is the amount that you need to feel comfortable. And I've been advising people to increase their emergency reserves lately because there's just more uncertainty out there right now. It's uncertainty about just job displacement. The economy is slowing and we do have considerations out there that are new with AI. Now the threat tends to be a little bit more white collar by nature. So there are people who are used to making a lot of money that not only, let's say you make $400,000 a year,
okay,
right? And you're a software engineer and that job goes away. If you're in that situation, not only do you need an emergency reserve while you find a new job, there might be a chance that the new job that you find isn't going to pay the same amount of money. That's, I think, the biggest risk is not necessarily will there be jobs, but there's a certain amount of lifestyle that you get adjusted to, and you get adjusted to it because it's afforded by the job that's provided to you. If that type of income goes away or it's harder to find, then it's not just about making sure that you can pay the next 3 months rent. It's about making sure that you can bridge the gap.
Yeah, I mean, lifestyle adjustment's a really, really tough adjustment.
Right.
And we've seen people navigate it before, but it's a really tough conversation to go from being used to spending X amount and then having to go to spend less than that amount, because you do really get accustomed to your lifestyle, your car, where you shop for groceries, where you buy your clothes, where you travel, vacations. All of that stuff does become ingrained in you pretty quickly.
Yeah. And there are people that get, how do you explain to your kids that you can't take them skiing this year, for example, right? Or like when you have to make sacrifices, it sucks. No one wants to make those sacrifices.
Yeah.
And I understand that the alternative to this is not necessarily just like YOLOing on a stock, but building up retirement savings. You can feel like because when you have an emergency reserve, you're not putting it into a stock portfolio because you can't handle the volatility of there. Right?
Totally.
So it's where do you put the money. It might be in a money market or a high yield savings or slightly more like maybe some short-term bonds or whatever. You don't want to put it into CDs because you might need it.
And
right?
if it's in a CD, you either have to cash out and lose the interest or you won't be able to get it.
Yeah. So it's not ideal. And it's never as like sexy an alternative as like NVIDIA. Right.
Totally. Yeah.
So I understand that there's a FOMO aspect to it.
Yeah.
Right.
I mean, that's what I was saying before about the bank statements, figure out how much you spend. And then I typically do bring it up a little bit in the financial plan because, people often increase their lifestyle. They rarely ever kind of decrease that stuff.
Yeah.
It's traditionally what I've seen after doing this. But
yeah.
So how does someone protect themselves if something was to happen? And let's just say it's even more catastrophic than a job loss.
So actually, I have some data for you.
Oh, I'm
because
excited.
we love data around here.
Love me some numbers.
And so again, understand what you're spending. Step one. Step two, make sure you have some amount of that spending set aside. It could be that it's 3 months. It could be a year. It used to be if you had a stable W-2 income, it was 3 months.
3 months.
And if you were a business owner or an entrepreneur or just like a consultant, you might want to be 6 months. Maybe it's a year these days. I don't know. I think that the risk of missing out on a 10% return and settling for a 4% return is not something that people should be really worried about. But one thing that I thought was interesting while I was preparing for this conversation today, here's something most people don't realize. According to the 2025 Social Security Trustees Report, right? This is where they have to assess what the needs might be on the Social Security system.
This sounds like a riveting panel.
Yes. For an insured worker who has attained age 20, so you're 20 years old or older, the probability of becoming disabled between age 20 and normal retirement age is 24%.
Wow.
1 in 4, right? I have to tell you that I was not planning on talking about disability insurance today. but the probability of dying between age 20 and normal retirement age is only 13%. So premature death is a lower risk than disability during your working years. Like almost never talk about disability insurance, not just you and I, but as an industry, as a society, it's like such an add-on. It's like, the extra cup holders in the back seat of the car. It's not something people really think about like, hey, I need to have airbags.
For sure. I actually have a pretty cool story about disability insurance.
Yeah.
Doctors and surgeons often will be advised to get disability insurance. And the reason for that, and this has actually happened twice now for clients, is because there's something called true own OC.
Right.
And I know you're familiar, but for the people that don't know, it's not necessarily that when you become a doctor, obviously there's different types of doctors. So there's surgeons that use their hands, obviously, to do surgery. And then there are other types of doctors like your primary care, which, you go in that might not require, obviously, technical ability with your hands. That's more kind of conversational and testing. So there was a surgeon who was a heart surgeon, and it was based in the Northeast, and he was making close to $1 million a year. And he fell. I think it was when he was skiing and got injured and then developed a tremor in his hand.
Yeah.
And he was in his 50s. So essentially his income was going to go from $1 million a year to $600,000 a year. But keep in mind that that was taxable. Now, obviously a lot of people listening might say, come on, if you can't get by on 600,000, but when you're used to $1 million and you have a huge amount of student loans, you have kids, you have private school, you have college, all this stuff, like a $400,000 hit to your income when that's what you're used to is massive.
Yeah. I mean, the way to think about that is not like you still have 600, it's that you have 400,000 less.
400,000 less.
Yeah.
However, this doctor had a true own OC disability insurance policy. Now, you can't make up the 100% of your income with disability insurance, but he did take back it up to 90%.
Yeah.
So what I mean by that is that he still lost $100,000 of his income. But with that being said, he now has $300,000 of it as non-taxable because he was using after-tax dollars to buy the disability policy. And he still had his long-term disability insurance through the hospital.
Yeah.
Here's the kicker. So he could no longer be a surgeon anymore. However, he was able to take over the head of the surgery department, where he was then paid a salary of $1.1 million.
Okay. So don't cry for me, Argentina. Right.
So he basically doubled his income at that point because he had the disability policies in place. We have another client who, who had a ski accident as well. Another doctor,
Skiing
surgeon.
is sounding very dangerous.
Skiing sounding very dangerous. Same thing. Broke his hand, broke his wrist. Won't be able to ski again. He was 56 years old because he had a standalone true knock disability policy. He was able to retire 9 years sooner.
Yeah.
And he was going to retire at 62 because he had a true knock disability policy. He received his income up through 65.
Yeah.
So he retired 6 years sooner and got 3 more years of income from it.
See, that's, I think, look, I was skiing with my daughter this weekend, and she's discovered glade skiing. So she loves skiing between the trees. Like she thinks that's way more fun.
There's zero coverage at Gunstock. If you went in the glades, I went Friday. Yeah, I went Friday. There was no coverage.
I was at Sunapee and there was some coverage. And
my skis are destroyed.
It got worse as the day went along because it was 50 degrees. So spring skiing at its best is great in the morning and then it gets worse as you go along. But anyways, it's one thing when she's a kid and she just, wants to go and do something kind of weird and right? Like off the beaten path is very freeing. We have another client that is going to get, or he's in the process of getting term life insurance because he's about to go jumping from a helicopter while he skis. And I'm like, well, you got to disclose that. But it's, term insurance is I think very affordable. Like it's very easy to put term insurance in place. And there are so many commercials and companies for that. It's like, it's very prevalent in our society. Like people know what life insurance is and that if they have a family, they should have it. Right?
You can go online and do a Google search and find a term insurance from any major provider and they'll quote you up and get it in place quick.
Honestly, it's easier than having an emergency reserve, right? If you qualify for term insurance and it costs you $50 a month, $50 a month and building up into your emergency reserves is not going to get you very far very quickly.
No.
Right? This is like the easy thing to kind of slap on and figure out the rest. Disability insurance is rare.
It is.
I don't talk to a lot of people. Some people have it as a benefit at work, but Social Security also provides disability. That's why that report exists, is right? Because Social Security is there to provide some disability.
Yeah.
But it's not going to provide the amount that if you're a high earner, it's not going to fully replace your income. And when you have insurance through work, short term or long term, you have that insurance just reduces the Social Security payout.
Right.
So it's like, you don't get more. So I think that when you're looking at your life and you're assessing the risks, and in financial planning, we have to assess the risks just like you do with just investment selection, et cetera. The biggest risk is always going to be income replacement. If you don't insure against that, if you haven't made progress towards building that emergency reserve or getting insurance, and you have a family who relies on your income, then you shouldn't even be talking about your stock portfolio, in my opinion.
I totally agree. One thing I wanted to look up was what are the biggest claims to go out on disability?
Like the most average.
Yep.
Cancer is one of them.
Cancer is one of them. But it's things that you wouldn't necessarily think of. Anxiety is one of the biggest ones that people go out on disability for.
I know some people that should be filing some claims, I think.
Yeah, same. Chronic pain. So chronic back pain is a big one. Arthritis, joint pain, neck pain, soft tissue disorder. And then a lot of it is mental. So over 35% of long-term disability claims come from depression, anxiety, PTSD, burnout, bipolar disorders, and other mental disorders. So I think whenever someone hears disability, they think, oh, well, if I break my arm, I can still do my job.
Sure.
But that's not necessarily what we're talking about.
No, we're talking about something that's really debilitating. And I think other people have come across, like the first example you brought up it ended up being kind of a win financially, right? I think too often people come across somebody who is on disability and getting paid, okay, whatever they are, and they seem fine. Like they're just living their life, right? And that can kind of give disability kind of like some stigma, right? Like, but like I don't have disability insurance.
Neither do I.
And
we're 1099.
I was like, well, but you can still I was like, well, should I get disability insurance? Like I think that these are kind of like, because they're so rarely thought of, they're left field events. They can be essentially personal black swan events. And taking a time to prepare for this podcast today made me think about it. And now sharing it with anybody who's listening to this podcast is something that they probably weren't thinking about either. And again, the point of this was not to like sell disability insurance. The point of this is just to think about the things that can set you back, because we only want everybody to succeed. And sometimes you have to just prepare. You need to have airbags in the car, right? Or your seatbelt, and then you can drive your shiny car wherever you want to go.
One of my buddies was having a baby, had the baby. And while his wife was pregnant, she was 5 months in, he lost his job.
Yeah.
And he was freaking out because they didn't have benefits. And he was telling me, he was like, he opened up and he was really upset. And he kept being like, if something happens to me, like my family's done. Like I've got maybe 150K in a 401k. She's full-time stay-at-home mom with the kids, and they have multiple kids. And he didn't have any insurance in place. So if something happened to him, that's that. And I told him, and I was thinking this through, like, I'm like, well, term insurance is very easily solvable.
Yeah.
And by just checking that one box, that alleviates a lot of the stress right there.
Yeah.
Because then you don't have to worry. I mean, you still have to worry about your family. You're always going to worry about your family. But certainly that helps a little bit with one thing. I think another big fear is, to our point of the conversation today, is I think it's all about hedging and losing your job and benefits by going out on disability, something like that. I think what's really tough is if you're in this situation where you have to work, because even though you're in pain, you're mentally struggling and you feel like trapped in this situation.
Yeah.
Disability insurance is something that will help alleviate a lot of that stress.
Yeah.
Which, I haven't even thought about disability insurance in a long time.
Yeah. I mean, it's something that I think we should look into, right?
I agree.
I mean, it's funny. We recently were just talking about James Van Der Beek, right? And how like he probably did not have a couple of these financial pieces in place for his foundation, right? And because of that, his family was left with a house caving in, and they were not in good financial standing, and they had to go get help. And that to me is a tragedy that is so easily avoidable. And even without disability insurance, right? Like, if you've done the other parts of the foundation building, then maybe the disability insurance is like the fourth thing, right? Like just do these other things first, and then, we can figure out the rest. But I think that it's so heartbreaking when people suffer so unnecessarily, right? And if there are things that you can do to help your family, not, sure, from the grave, but also just like while you're here.
Yeah.
Because we all want to be here.
Yeah, of course.
Then I think we just have to encourage people to do this and look into these things.
Yeah. I mean, I think for me, and to summarize a lot of what we've talked about today, is, you should really be asking yourself 3 questions. It's, what happens if you lose your job? What happens if you lose your health? And then what happens if you lose your life?
Yeah.
And
great.
If you can answer those 3 things with a plan, you're so much better off than most people out there.
Yeah.
And I think I personally need to revisit those 3 questions myself. And I think it's a good exercise to think through those things maybe once a year, and to just check in on that to make sure that, you can solve for your job, your health, and your life. And that is a great financial foundation if you can do those things.
Yeah, 100%. And do it and look at those things jointly, right? And make sure everybody's on the same page. Looking at things with an advisor is certainly a good way to do
helpful
that.
thing. Yeah. And definitely bring your family into the conversation. We were on a financial planning meeting recently. A husband's objectives were different than the wife's objectives potentially.
Yeah.
And, it's good to have those conversations so that way there's no question marks if something were to happen.
Yeah. I mean, we could have a whole conversation about, one member of the marriage being left out of a lot of the planning, and how often that happens, and how frequently it's the woman.
Yeah.
But that's a whole can of worms we won't unpack today.
That is, but I think this is a good place to wrap it. Anything else we should add?
No, that's it.
Okay. Well, for all of those listening, thank you for listening
and watching.
And please give us a like, subscribe, and share with a friend, colleague, stranger, person you know.
Stranger Things.
Oh,
also send questions.
Yes.
Questions are good.
Questions are good for our mail dumps.
And also some critiques. That's fine.
All right. Thanks, guys.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin. Sponsored by Ko-Fi Advisors. Reach out today. Yay!